Welcome to the What to Watch video update. This is the last video that I do over the weekend where I pull out the charts that seem to be really telling us something right now, and I put them into one of three categories: a positive category, a negative category, and a what to watch category. And we try to figure out, are we getting some clues from the market from all these different charts to give us more confidence that we're going to continue to go up? Or are we seeing some trouble on the horizon and just some things that are outside of the S&P 500 that could come in and actually have an influence, either positive or negative? We're asking the question this week, will trade news that broke on Friday and will probably break over the weekend and it'll break in the upcoming week, will that news, and we're also extreme positive with sentiment, I'm calling it over-exuberance, cause the S&P 500 to actually decline? And this is being prepared for Monday, July 14th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. First, we look at the positive side of things, and it's still quite a long list. We're not really seeing any problems yet, but there are some things that we want to keep an eye on right now. First of all, the daily chart looks pretty healthy. We are in an uptrend. We have a recent golden cross from the S&P. We're setting a series of all-time highs here, even though we were down a bit in Friday's session. The red dashed line here, that's the previous high that was set back in February. So this is still looking pretty healthy overall. Now, one thing that is a bit concerning, but not necessarily surprising, is that we continue to be below average with volume. And that's usually a technical analysis negative divergence when you're going up, setting new all-time highs on a decrease in volume. And you can see even the moving average that I use here, even that has been declining overall. But for the most part, this chart is still looking positive as of right now. This is where we're getting a little bit concerned. Now, we're positive as far as the fear and greed index. We're getting quite a, a high reading here. But when we get up to this 75 level, that's, as I usually say, that's when we start to introduce the idea of using this as a contrarian indicator, meaning that, okay, everybody is just expecting that the market will go up, and that's usually about the time when the party's over, at least in the short term, sometimes in the intermediate term. If we do continue to see a pullback like we saw on Friday, and the market really held up quite well given the fact that it was some negative news that hit, we didn't really see an awful lot of conviction, but it didn't really fall apart either. Okay, are we going to start coming down with this? Now, as a general rule, when this is going up, the market's going up. When this is going down, the market's going down. So we'll keep an eye on that. And this is what I'm calling that over-exuberance. Okay, we're still looking good here with our intraday growth to value charts. The blue line is still above the red line. They've slowed down a little bit. We're not seeing as much of a separation as we saw before. That's not as much of a concern. The general idea is if the blue line's above the red line, which it is, and we're still tending to go up overall, and that's still looking positive there. Then the S&P growth to value ratio intraday, this is still going up. Now, the 1st of July, we saw a real downward move here. That was the first day of the month, the first day of the quarter, and you saw a lot of money coming into the market, and value had a really good day that day, and that really pushed this ratio down. Well, since that time, we've been coming back, and for the most part, we've been going up, and that's positive for the market as well. We're under 20 with the VIX. We're still coming in the 16 range, which is fairly good. It's not as low as the 13, 12 readings that we were getting in the past, but the fact that we're under 20, that's when we see positive annualized returns for the S&P. So that is positive. And even though we're getting a bit of a hit here with the small cap growth to value ratio end of day chart, we're still in an uptrend overall. And the small caps had a pretty good week until Friday. They gave back the gains that they were seeing. We'll see if we can get some more follow through to the upside. That would help the overall market. But we've been faked out a lot by the small caps. They seem to do well and then give back their gains, do well and then give back their gains. And that's been the basic pattern over the last couple of years. But when we just look at growth of value, that's still looking positive, even though it's dropping down below its 50-day moving average. Also declining a bit here with mid-cap growth of value. Also a bit of, we really haven't seen as much give back here, but we just kind of go sideways with the mid-caps right now. But the growth to value ratio is still looking pretty healthy. This is the one that I look at the most. This is S&P growth to value, and this is still in an uptrend, not too far off of its highs, and for the most part, it's been going up. So that's positive there. And then we look at a growth to value two ETFs and do a ratio between the two, and this is holding up above the rainbow. Discretionary is improving, and that's positive for the market. In fact, we've been going sideways with staples, and we've been seeing a bit of an upward move here with discretionary, enough to almost generate a golden cross with the discretionary equal weight sector itself. But we're also seeing a golden cross here with the discretionary to staples ratio. And so that's improving as well and taken as positive. And then we look at our various growth to value ratios. Still looking okay with the Qs to S&P. Improving, but still below a declining moving average, and just trying to come a little bit above the moving average here when we look at discretionary to the S&P. And when we compare large cap growth to large cap value, we're still above an advancing moving average. So that's taken as positive. So the large caps kind of going sideways now, just with the growth to value ratio here. A little bit below the moving average with the mid caps, and still looking a little weaker now with the small caps below a declining moving average with the growth to value ratio. But when we look at large cap growth, that's been the real driver of the market, and it continues to do so. It's above all the moving averages, setting recent all-time highs. The risk on to risk off ratio still going up, and that's positive. That means folks are willing to jump into the market and go risk on, and that's when the market is more positive. Also, high beta to low beta ratio continues to go up. It was down a little bit on Friday, but the bigger picture is that it continues to advance, which is positive. And then the value to tech ratio is going down, which is positive for the market as well. This also is kind of an inverse of what we were just looking at, and this declining is more positive for the market. S&P to utilities ratio, for the most part, is continuing to go up, showing a little bit more conviction there, and that's positive. And the condition of our trends. First, we look at the 20-period moving average. That's what I base the short-term trend on. We're still looking good. We're a little bit below the lines right now after Friday, but for the most part, the lines continue to go up, and that's positive. Intermediate term trend, a little bit below the red line, but both the red line and the blue line continue to advance. That's positive in the intermediate term. And then this is kind of short and intermediate term together, called a bow tie. We're still above this green fluorescent 10-period simple moving average, and that's even shorter than the 20-period that I use. And all of the lines are still going up in prices above all of the moving averages. So that continues to be positive. Now, this is positive, the Landry Light, and I pointed this out a week ago because it's still continuing and will continue to look to give us a bit of a warning sign. We're going above this 40 level, and we got a little bit below the minus 40 level, and that's about when the trend reversed as far as this chart. When it starts to get kind of long like this, and this is more time, that we've just been in this uptrend for a series of many days now. And so we're a little bit concerned about this, but until we're proven otherwise, this is still looking positive. And we're positive with the balance of power. I usually don't show this chart in this particular video. I show it in a daily video, but we're getting extreme. And we don't see very many extreme readings here. It doesn't necessarily mean a reverse. It can mean that, but it might just mean some more sideways action as we continue to work our way through the dog days of summer. And we're positive with the advanced decline line, both based on price and volume. We saw a little bit of a decline on Friday, but we're still above these advancing moving averages. And we're still positive here, even though we've been coming down with the advanced decline oscillator. This looks at a 10-period simple moving average of the advancers decliners. We had become extreme. We're working our way back down now, and we're still above zero, though. So that's why this is treated as positive. And then we look at the new highs, new lows, and we're starting to flatten out here with the 5-day and the 10-day, even declining a little bit with the 10-day. And it's not that we're seeing an expansion of new lows. It's more that we're seeing a pretty significant decline in the new highs. And that's what's causing the moving averages to roll over. But for right now, that's still treated as positive. And then we have our smart money indicators, accumulation distribution. We're still above the advancing moving average. Now, in the short term, we're turning a little bit more negative. This is the boom indicator, and this measures the short-term interaction. It's supposed to between the indicator and the moving average itself. And this is actually starting to decline. So in the shorter term, looking a little more negative. In the longer term, we're still looking positive. And the advanced decline ratio, we're declining here, but we're still above zero. So that's still positive. And then our other smart money indicator, we have three of them. The Chaikin money flow continues to go up. The histogram is advancing and the red line's going up. And then smart money indicator number three, still above the moving average with the Chaikin oscillator. But we're above this red line, which is the initial area that we go, uh-oh, maybe we're getting a little extreme with this. We got up to the green line and we've been falling back, but now we're starting to bounce back up. But for right now, this is still positive. Vortex, green line going up, red line going down, that is positive. And we're positive here. This is longer term, a 10-day moving average of the highs and lows for the S&P. We started to come a little bit above the green line, which shows good longer term momentum. We're dropping back a little bit, but for the most part, this is still positive. And we're still positive here, even though we're declining with those stocks in the S&P above their 20-period moving average. It is coming down after getting above this 80 level, but positive is when we're still above 50. We want to watch this. If this continues to fall, the context would mean it's a little more negative. But for right now, the slight pullback that we've been seeing is still keeping this indicator positive. We're also declining a little bit with the 50-period moving average study, 100-period moving average study, and 200, but they're all still positive in the bigger picture. Looking at the trend, short term, we are still positive. The ADX, that's the dark line. It's still above its moving average. It's above 20, and the green line is above the red line. Intermediate term, still positive here. Above the moving average, green line above the red line. And then the weekly trend, it's a weakening trend because we had been negative, but we recently saw the green line crossing above the red line, so this is now turned to positive. Even though this is still considered to be a weakening trend, it is still a trend that is now positive. And the daily chart of the parabolic SAR is positive, and the weekly chart for the parabolic SAR is positive. We're looking positive with momentum, but looking a little extreme here. The slope oscillator, which is a short-term oscillator, that's above the green line. It's still above its moving average. The other short-term oscillator, the TSI, also still above its moving average, but slowing down a bit. Where we're seeing a little bit more weakness is more in the intermediate term. We're starting to flatten out with the MACD, the PMO, and the PPO, but they're still positive for right now. We're also positive but extreme with the TRIX and KST. These are our two long-term oscillators. We're above the green line with the TRIX and not very far below this blue line here with the KST. But we're still positive when we look at the Copic curve momentum oscillator. Now we look internally, long-term, 50-period moving average of the new highs, new lows for the S&P, still above zero and advancing. That's positive. We're above all the moving averages that we plot here, and the moving averages themselves are going up. But we're far away from those moving averages. This is the boom indicator that I use in a different way. This measures how far away we are from the 20 and the 50-period moving average, and we're extreme. This works like an oscillator where we get extreme positive or negative readings. We're still doing okay here with the 200-day moving average, but we're a little bit concerned about this. It's positive, but it's been extreme positive now for a number of days. Longer term, a weekly chart, still looking good here. We're seeing a series of higher highs and higher lows, even though we had a slight down week this past week. And even on a weekly basis here, we're dropping below average with volume. Then this is a buy signal, which it's kind of confusing because usually this triggers a signal after we've had a severe decline. Well, we were going sideways, and then coming up out of that, we had a praying bottom fisher buy signal here. I wouldn't necessarily trust this or use this all by itself, but it is giving a buy signal, which is positive. And this is the advanced decline line across different indexes. We're looking good here with the NYSE common stock, the S&P, mid caps, and small caps. We're still above advancing moving averages. And we are declining now, but we're still above zero with the NYSE McClellan oscillator. That's more broad market. So we're continuing to go up with the summation index based on price and volume for the NYSE. The NYSE bullish percent index, it ticked down a little bit on Friday, but it's still positive overall. And we are declining, but we're extreme here with the NASDAQ 100 bullish percent index. Then we look at the Dow, which probably is going to generate a golden cross here. It's one of the main indexes that has not done so yet. We've seen it in the S&P, NASDAQ, and NASDAQ 100, but we would have to really come down big time and really go down to stop that golden cross from happening, which will probably happen this week. And then the NASDAQ, recent golden cross, not really moving as much as far as price, but still looking pretty positive overall. NASDAQ 100, recent golden cross, still looking pretty positive there. The small caps, they're on the positive side because they're still above their 200-day moving average, even though they did not have a good day on Friday. We're seeing some improvement here. What we're going to be watching for is continued move to the upside, or are we going to get faked out again? And after seeing a nice little run up, are we going to continue to pull back with the small caps? And then we have another small cap index, the Russell 2000. We're still above the 200-day moving average here. And this is actually a pretty good looking bar pattern. Can that continue? Or are we going to start to see some weakness with the small caps? Mid caps kind of going sideways right now, but still holding out above this R1 pivot point. They're probably going to generate a golden cross here fairly soon unless they see a significant decline. In a broad market measure, the Wilshire 5000 still in an uptrend. That's positive. And another broad market measure, the total U.S. stock ETF, recent golden cross, setting a recent all-time high. FANG index, these are the really big stocks. Not really doing much over the past few sessions, but still in an uptrend nonetheless. And then the staples to tech ratio continues to go down, and that's positive for the market. And we're seeing a recent death cross with this ratio. That means that the tech sector is outperforming staples. Staples are more defensive, tech is growth. Then we do some ratios between stocks and bonds, and you're going to see a lot of the same thing here just to confirm what we're seeing. This is the S&P to 3 to 7 year bond ratio, and we're still going up. We're above the rainbow. When the market is in this kind of an environment, that's when they're anticipating a soft landing, meaning that there will not be a recession, according to the market. That was really thrown into question here as we were declining in March and April, but then we were able to come up out of that. Then this is an inverse of that same chart, showing how bonds are underperforming, and we're starting to see a death cross here with bonds underperforming even more than stocks. Then the S&P 1500, the short-term bonds, looking pretty solid right here. Another broad market measure, and then we go out to 3 to 7 year bonds, also above the rainbow. The tech sector to 3 to 7 year bonds looking really solid. The QQQs to 3 to 7 year bonds also looking really good. And then a 5-period moving average of the highs and lows across the Amex, NASDAQ, and NYSE. We're still above zero. We declined a little bit recently, but we have been going up. And so this is still taken as positive. And then the semiconductors, which are a huge part of tech, and tech is pretty much growth. And when the semiconductors are doing well, the market is doing well. And we're setting recent all-time highs here with the Dow Jones Semiconductor Index after our recent golden cross. And then the SMH Semiconductor ETF also looking pretty solid. And then we do the semi to tech ratio, and it's more positive when this is going up. That means the semis are outperforming the tech sector. Now, that's what happened at the beginning of 2024. Now, we were still making new all-time highs back in the summer and fall in 2024, but this ratio was going down. So the market can still go up, but it usually shows more power and more conviction when this ratio is going up along with the market. Then we want to keep an eye on some different ratios. The top area is a weighted version of discretionary to staples. That's really not doing all that much because Tesla and Amazon are the two big companies in there, and Tesla is still having some problems. Where we see an improvement is when we look at an equal weight version of discretionary to staples. This is actually showing some more strength here, and that's positive. We're also seeing some positive action here with tech to utilities. That's growth versus value. And then biotech growth to healthcare value. Healthcare is really continuing to struggle. That is continuing to go up. And then hotels, which are discretionary or growth, that has been going up when compared to utilities. And we keep an eye on the main industries that really support the U.S. economy. Semiconductors are looking pretty good. Home builders are improving, but have a lot of damage to repair. The transports have really been improving here. They're actually looking kind of good. Retail has been holding up fairly well, and we started to go up, but now we're going sideways with the regional banks. Then we look at a long-term chart of the NASDAQ 100. Now, this is positive, but there's something to be aware of here. This trend line that I drew, and I tried to connect these lows from 2009 up to 2016 and then extend the line forward. This could be acting as overhead resistance. Now, in the past, we did get above this trend line, but we didn't get very far above it. So we're wondering if this is going to produce some kind of a problem, but it hasn't yet. We just want to keep an eye on that. And then we look at the growth, NASDAQ 100 to Dow value ratio. That's still looking pretty solid. This growth, QQQs to small cap, that's not value, but it's big growth to little growth here. This is still well above the blue line. And then the semiconductors to Dow. For the longest time, this was on the negative side. We were seeing a series of lower highs and lower lows. When we look at semiconductors growth versus the Dow, which is considered value, we're finally starting to come up out of that and breaking that and getting closer to this blue line. That's positive. And then we look at the staples to S&P ratio, similar to the staples to tech ratio. When this ratio is going down, that means the S&P is outperforming, and that is positive. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Now we look at the negative side, and there's not very many, but still some things we want to keep our eye on here. We did have a down week. Now, you could take some positive things and negative things away from this. Since we ended up closing down, that's why it's on the negative side. But really, things were looking pretty positive. Wednesday, we had a pretty nice up move, and then finally on Thursday, we had a nice up move, closed a bit off the high. Then we gapped lower. Now, we could have just tanked on Friday, given the trade news that came out, but the market set the low pretty early in the session. It didn't show an awful lot of conviction. It was really choppy here, but it held up fairly well, and we ended up closing a little bit above S1. So we were down, but given how the market reacted last March and into April, this is pretty good. Now, is it going to continue to do that? Is the market going to continue to throw off this trade news as, oh, it's just a negotiating tool. Oh, he doesn't really mean it when he says these crazy things. He's just trying to bring these other countries to the table. Or is something substantial going to come out that the market is really going to end up reacting to? Now the NYSE McClellan oscillator, it declined, but it's still above zero. Where the S&P McClellan oscillator has now dropped below zero, so that's turned this negative. And when the McClellan oscillator is below zero, you can't really see it here, but we're actually declining here with the summation index based on price. We're leveling out here based on volume. So we're getting a bit of a mixed picture here, but we're leaning a little bit more negative for right now. And the swing trading oscillator, even though we held up fairly well over the past 5 trading days, this continued to decline. It's seeing something that it doesn't like, and so we're declining based on price, and just barely above zero here, we're also declining based on volume. And then we're positive with the bullish percent index, and now the bullish percent indexes for the NYSE and the NASDAQ 100, those are still positive. I don't put moving averages on those. I do put a short-term moving average on this to give us an idea what is the short-term direction of this indicator, and we've now dropped below the moving average. And that's why this is negative after giving us an extreme positive reading. So in the bigger picture, it's positive, but it doesn't have a lot of room to go to the upside before it's pretty much topped out. So for right now, I'm treating it as negative until it proves otherwise. And then the momentum for the NASDAQ 100 is flat and actually starting to turn down here a little bit. Even though we're just coming off of recent all-time highs, we're not seeing an awful lot of conviction as far as the momentum indicator. The financial sector, this is positive all by itself, looking pretty good. What's causing a concern is when we do a ratio between the financial sector and the S&P. We held above this 200-day moving average with the ratio and bounced up off of that. Now we're starting to drop below it. Now the banks, the big banks, they're going to come out with their earnings reports later in the upcoming week. And if they're positive, that's probably going to take care of this. If they're negative, we might see this ratio continue to go down. And this is actually improving, but still negative overall. These are the smaller banks, regional banks to the financial sector. And we've been seeing some weakness in the financial sector compared to the S&P. Well, we're seeing some regional bank strength here compared to the financial sector, enough to get back above the 200-day moving average. So it's negative from a trend perspective, but positive in that it's been improving lately. But we're also concerned about the financial sector as it's relating to the S&P 500. Then we look at home construction, improving, coming up into the rainbow, but it won't really be treated as positive until we break above the rainbow. And this was an area in late 2024 that really started to break down before we saw some problems in the market. And that was giving us a bit of a heads up. Now, is this telling us that things are looking better if we're seeing this ratio going up? That's what it could be. But for right now, it's still treated as negative. And long term, a daily special K oscillator. And I just show it in this video and I show it in the deep dive video because we only get, well, we didn't get any signals in 2024. We just had a couple of signals in 2023. This continues to be negative, but the weekly version of this chart, we're still above the red line, and that's hanging on to being positive. And then the mass index, it did trigger a signal. It dropped down below both of these lines, and since we were going up when the signal was generated, this is suggesting that a reversal to the downside may happen. Now, there's some things that I'm going to talk about later on, and there's a breakout video that I'm planning on doing that's going to talk about this because we're coming up into the middle of July, and this sometimes is when we top out for a while in the market. Doesn't mean it's going to happen this time, but it happened in 2023 and it's happened in 2024. This is kind of playing into that overall scenario that we might see a decline based on this chart. But we have, remember the big long list of positive things? Those are still outweighing the negative things that we're seeing right now. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. All right, then areas that we're just watching. These are the pivot points for Monday's session. They're updated daily on the YouTube community tab. Then we want to keep an eye on jobless claims. Now, the initial claims, they're going down. That was actually a surprise for the market when that came out. So this is showing that the employment situation is holding up quite well. Where we're a little bit concerned are the continuing claims. So companies are real reluctant to let people go, but the people that do lose their job, they're starting to be unemployed for longer. And now we're still below 2 million here with this reading. If this continues to go up, that's going to cause some concern. And here's everything together. You have the red line, which are the initial claims going down, the continuing claims going up, and then the most recent unemployment rate at 4.1%. And we want to keep an eye on volume. Not really a surprise that we're below average, but through most of this advance, as we've been coming back up, we've been below average, and that's a concern, but we're still going up anyway. So it's important, but we don't want to necessarily say, oh, well, we can't get into the market going up. We're below average with volume. But still, it would be nice if we saw volume confirming the up move. And then we're getting a little bit closer again to that 4.5% level. We really spiked up on Friday with the 10-year yield. The red line here is that 4.5% line. Now, if we get above that, that's often when stocks go, uh-oh, and they have a tendency to go down more than up. So we'll be watching the 10-year yield. Oil, it had dropped down. Now, OPEC Plus came out and said we're going to pump out more oil over the summer, but oil's been going up since then. Usually it's the other way around. When there's more supply on the market, oil prices go down, but you've got the Strait of Hormuz, you've got things between Israel and Iran, and oil is kind of going back up right now, even though it's still in a downtrend overall. And then the dollar has been bouncing up. It could have been from real extreme oversold conditions, but we're still in a downtrend. Here on the daily chart, I don't have it here, but the weekly chart is also in a downtrend. And then we want to keep an eye on the relationship of different kinds of bonds to see if it's telling us, is the market concerned about inflation and interest rates? We look at the cash to 3 to 7 year bond ratio, not really a problem now. Then we look at tips, which do adjust for inflation and interest rates. That's what people get into when they're worried about inflation and interest rates going up. And it's going up here, but we're still in a downtrend with this ratio. Then we look at tips to 7 to 10 year bonds going up a little bit here. So we'll keep an eye on that, but it's not really breaking out of the range. We've been really choppy with this lately. And we want to keep an eye on the spread between risky bonds like junk bonds and not risky bonds like government bonds. Even though it's coming down here a little bit, that means fear is increasing. Overall, we've been really coming down with the fear as this chart has been going up. And so we'll just keep an eye on this and see if we see an overall change, but not much of a change as of right now. And we're at even. When we look at the yield curve between the 10-year and the 3-month, they're at 0 right now. We go uninverted, then we go inverted. Now we're back to even. And this could be giving some warning signs of recessionary concerns down the road. But the 10-year to 2-year, which is what most folks follow, that's looking fine. That's still going up as far as the yield curve. And we just keep an eye on the German DAX since it's the biggest stock market in the EU. Retraced down to its 50-day moving average and now bouncing back up from that and in a pretty solid uptrend. And then we look at a ratio between the S&P 500 and the German DAX. When this is going up, that means U.S. stocks are outperforming. Saw a little bit of a pullback, and now they're starting to go back up slightly here. This big decline, this was at the beginning of 2025 as European stocks were outperforming U.S. stocks. And we are improving here, but we still haven't assumed the leadership with U.S. stocks being taking or overplaying or outperforming. That's what I was trying to think of, outperforming global stocks yet. But there is some improvement with that ratio. And then this is what I want to point out, and I'm planning on doing a video on this. Now, 2023, in hindsight, ended up being a pretty good year. We set the low back in October 2022 and then came up out of that. And then we kind of made our way back higher. And we were coming back. We weren't setting all-time highs at this point, but we were breaking out after that bear market. And then we got into July, and then we had a pretty significant pullback that we saw initially come down, a little bit of a bounce, and it actually took us all the way down into the latter part of October before we bottomed and then had a good solid finish to the year. Okay, then in 2024, doing pretty good, setting all-time highs now, right about the middle of July. Then we saw almost a 10% decline here. And then the smart money came in and started buying, took us up out of that. We had a bit of a retrace and then ended up finishing the year fairly strong. A little bit of weakness going into 2025. Now, we're in 2025 now where we're setting all-time highs with the S&P. We're getting into the middle of July. I'm not predicting anything. I'm just saying, could something play out in 2025 similar to what we saw in 2023 and 2024? We're just watching for that. We'll let the charts tell us if that's actually happening. I don't forecast, I don't predict. I just look at what the facts are telling us right now. And based on what has happened recently, we at least want to be aware of this going forward. So thank you. I hope you're having a wonderful weekend, and I will talk to you in the next video.